purposes of proper videos arrangement, I'll write special revision. I'll write special revision so that these gentlemen can pick the videos easily. So have they found the question? Have they found this question? Yes. So we hereby read it. So we are saying there, ladies and gentlemen, Alumax Limited produces a single product branded sulfur. The machine used to make sulfur is obsolete, and the Alumax Limited is contemplating replacing it. Additional information: the replacement cost of a new machine is 1 million with expected useful life of 5 years. The machine will have no salvage value after decommissioning it. It is expected that 20,000 units of sulfur will be produced and sold at a transfer price of 300 per unit over a 5-year period as follows. And I hope you guys are able to see the units sold. If you add them, 6 plus 5, that is 11, plus 4, that is 15, plus 3, 18, plus 2, that's how they got their 20,000. The figures there are in thousands. Variable costs are expected to be 165 per unit produced and sold. Number 5, incremental fixed cost, mainly the wages of a maintenance engineer, are expected to be 200,000 per year. 6, Alumax Limited uses an imputed interest cost of capital of 13% for the investment appraisal purposes. Depreciation on this machine is calculated on initial cost of the investment at the start of the year. Required, they want us to give them residual income. So they want us to give them residual income. So this then will be profit minus cost of capital employed. Remember, COCA stands for cost of capital employed. Cost of capital done what year? Cost of capital employed. That is our COCA. Yeah, so if I'm the one doing this question, I will first of all get depreciation. That's straightforward, low hanging, give us depreciation per annum. Depreciation per annum. So have they given us the policy of depreciation? Yeah, so you can see note 7, depreciation on this machine is calculated on initial cost of the investment at the start of the year. No, that's not a very good policy. Yeah, note 2, the machine will have no salvage value after decommissioning. They haven't told us. So in that case, automatically we shall use straight line method. There is no way we can use reducing balance here, because for reducing balance, you need the percentage of depreciation. So here, this will be straight line. And if it is straight line, we are taking initial cost, we subtract scrap value, and then we divide by number of years. We divide by number of years. So are you able to see the initial cost, my good friends? Initial cost, if we are to bring this machine today, how much shall we pay? Yeah, this special revision, remember, I have to involve you a lot because all of us are at the same level, eh? Yeah, same level. It's 1 million. Yeah, thanks, Purity. So 1 million. What is the scrap value? They have told us scrap value is 0. And they have told us that this particular machine we are bringing on board will have a useful life of 5 years, not number 1, 5 years. So it means that every year, the depreciation will be how much every year? 200,000. So every year, the depreciation will be 200,000, like that. Every year, depreciation will be 200,000, like that. And then, ladies and gentlemen, remember, if I'm the one doing this, I will come and give you straight away what we call the written down value. Written down value. Written down value is the same as the net book value. So written down value at the beginning. So at the beginning, I have my 5 years, 1, 2, 3, 4, 5. So when it is brand new, at the very beginning of year 1, it was worth 1 million. We stay with it for a whole year, it loses 200,000. So at the beginning of year 2, it will be worth how much? Somebody take away 200,000 from 1 million. It will be worth how much? It will be worth 800,000. And you keep doing that. You keep on doing that throughout. So 800,000, 600,000, you are deducting 200, eh? 400,000 at the beginning of year number 5. This will be 200,000 at the beginning of year 5. At the end of year 5, we expect the thing to scrap at zero. So this written down value, what shall I use this written down value for? You management accountants, what shall I use written down value for? Yeah, somebody should be able to help. Vashiria. Okay, I've never heard of such a name. Great. Every day is a learning day. Every day is a learning day. So someone should be able to help them. They want you to send a screenshot in the group. If you don't mind, you can just take a snapshot of the question and then you send that picture on the group. So I will be able to use this written down value as my capital employed when I'm getting my residual income. When I'm getting, in this case here, my ROI, I will use this as capital employed, which is equivalent to net what here? Net assets, which is equivalent to net assets. Now from there, I need profits. So for profits, I would want to do a profit statement. Let's do a profit statement. Let's do a profit statement. A profit statement. So I have my years 1, 2, 3, 4, 5. So we have here price, selling price. Are you able to see the selling price, ladies and gentlemen? Are you able to see the selling price, ladies and gentlemen? Shared. Thank you so much, Maggie. Thank you so much. Maggie does not disappoint. So the selling price, they gave us a selling price. So selling price that they gave us, ladies and gentlemen, is 300. Yeah, in note number 3. So selling price is 300 throughout. Per unit, it doesn't matter which year number. When it comes to selling, I will sell this at 300. Is there somebody who is able to see the variable cost? The variable cost, have they given me the variable cost per unit? Oh, yes. Note number 4. Note number 4, they have told me variable costs are expected to be 165 units produced, per unit produced and sold. So variable cost will be 165. It doesn't matter. 165, 165, 165. Let me ask you a question. Whenever you see price and variable cost like this, what comes to your mind? Whenever you see price and variable cost, what comes to your mind? You management accountants, great management accountants, CM. So come and give us CM. Come and give us CM. And I think today there is something you guys have not done very well. There is something you haven't done very well. How can we be 69? This class normally goes up to 100 plus. I'm so sure you haven't told your classmates in the paid group, that this class has begun. Don't share with the other people outside there. This link is for the paid students. Have you told them that the class has begun? Have you told them that the class has begun? Yeah, because I would really wish to have so many of you attending the revision. So then we have our contribution margin. Our contribution margin, I'm being told, is 135. Done. Thank you so much. Yeah. So we have here 135, 135, 135. Hey, great accountants. Then once you have this, you as a great accountant, what will come to your mind to be done next? What do you think shall we do next? Don't tell me nothing, and yet I'm calling you a great management accountant. Yeah, CMX, yes. CMX. In the paid group. So most recent handout, which I'm not using today, by the way, So somebody can share that handout, AMA up to topic number 5, the most recent one, share it there, but I'm not using it today at all. Today, we are not using it at all. So in this case here, they have told me to come and put quantity here. So quantities, I can see the quantities for the respective years. I can have this in thousands as well. 6, 5, we have 4, 4, 3, and then we have 2 like that. And they have told me to go ahead and multiply to get what we call total contribution. So 135 times 6, 135 times 6, 135 times 6, 800. Yeah, I'm recording, yes. So in this case here, we have 810. 810, Bahati. Thank you so much, 810. Yeah, second one, 135 times 5. So you can write here that you're multiplying, because this total contribution is CMX. We are multiplying. We are multiplying. We are multiplying. We are multiplying. Okay, so 675, thank you so much. We take on the next one, 135 times 4. 135 times 4, we are getting 540. 540. From there, we have 135 times 3. 135 times 3, which gives us 5, which gives us 405. From there, we have 135 times 2, which gives us 270. Now, ladies and gentlemen, from there, what do you think will be the next thing then to be done? What do you think will be the next thing to be done? Yeah, fixed cost, because you're bright students. We know at the end of the day that profit will be CMX minus fixed cost. Minus fixed cost. And of course, depreciation is outside the game. I must come and subtract what your depreciation. The only thing I will not subtract is tax. Is tax. So then come here straight away and give us fixed costs. Fixed costs. So have they given me fixed costs anywhere? Oh, yes, they told me in note number 5. The incremental fixed costs, mainly the wages of a maintenance engineer, are expected to be 200,000 per year. 200,000 per year. Remember, our figures are in thousands because of this quantity. So these figures are in shillings, thousands. So then we only charge 200 here. 200 there, 200 there, 200 there, 200 there. So please get ahead and subtract so that you will also be able to subtract depreciation. Depreciation for you to get operating profit. So are you able to remember the depreciation, my good students? Are they able to remember the depreciation? Yeah, so depreciation is 200 as well. We calculated it. Depreciation was 200, yeah, 200. So we have 200, 200, 200 there. Then we have 200 there. So then, ladies and gentlemen, go ahead and give me what we call operating profit. Give me operating profit. So operating profit. So give me what we call operating profit. So are you able to get the operating profit yourselves? So operating profit, ladies and gentlemen, that I'm able to see there pretty fast, which my students have been able to give me. The first one is 410. The first one is 410. The second one will be what here, somebody? The second one, we have 275. Thank you very much. 275. The third one, because you are taking here 540 minus 200 minus 200. Minus 200 minus 200. So I'm told that the third one is 140. And then we have the fifth one. I can see it is 5. This one will be a negative, A negative will be a loss. Negative 130. Negative 130. So then you should be able to give me residual income very comfortably. You should be able to come here and give me residual income. Residual income. Is there anybody who is able to remember the formula for residual income? Formula for residual income. So formula for residual income, we know it is profit minus cost of capital employed. So we have year 1, year 2, year 3, year 4, year 5. So the profits already we have. We can fix them here. 410, 275, 145 minus 130. So minus, the cost of capital given in the question, the cost of capital given in this question, great students of mine, I can see automatically there, it is what percentage? 13%. So 13%, 13%, 13%, 13%, 13% of what was invested at the beginning of every year. What was invested at the beginning of every year, it shall be these written down values. So remember, they have to be in thousands. So this is 1,000. This is 800. This is 600. This is 400. This is 200. So then you should be able to give me an answer. So residual income. Profit minus COCA, yes. Profit minus COCA, cost of capital employed. So from Maggie is able to give me the first residual income. The first residual income, according to Maggie, is supposed to be 280. 80, thank you so much. 280. So go and pick the second one. This is really easy, really easy, really easy. So the second one I'm being told is 171. The second one is 171. How about the third one? $62 from Shayla. 62 from Shayla. Thank you so much. Then we have year number 4. Year number 4. Year number 4. 47, eh? So year number 4, I'm being told it's 47. 47. Negative, eh? Negative. A negative residual income. That's a very bad year for us. And actually the very worst is year number 5, where we have a residual income of a negative what year? 156. So they asked us to give them the residual incomes for each of the years. For each of the years. Should they ask us to give them average residual income, then first of all, I will come here and give them the total residual income. Should they ask me to give them the average residual income, so I'll be able to come and do the summation here. Get a total residual income, which in this particular case will end up being equal to who? Total residual income, according to Maggie, it is coming to 310, and therefore the average, will be 310 divided by the number of years, which are 5. The average will be 310 divided by 5, which is 62. So up to there, ladies and gentlemen, as a performance measure, are we really together? Have you been able to follow? Have you been able to follow so keenly on what we've been doing? Thank you so much. And ensure that should the examiner bring this, then you should be able to give the question justice. We don't want this situation where students after exam room, they're walking like, it's like they're coming from war. Which war is this? Which war is this? That shall never happen to you. We should be able to shine and come out of an exam room smiling. That is the objective here. The objective here. Not like you are coming from a war, which actually, in fact, they were even making use of bombs. It's like you saw a bomb, a real bomb. No, that is not our portion. So from there, ladies and gentlemen, we go in this case here to ROI. ROI. Yeah. So in this case here, this cost of capital employed, you can also call it imputed interest. You can also call it imputed interest. I rarely use it, imputed interest. Yeah, imputed interest. Yeah, imputed interest, all right. So then we go straight away to return on investment. So return on investment, even notional, you can as well get people using notional interest, but rare. I've never seen it, rare. So then get ahead here and they give me, in this case, ladies and gentlemen, give me the ROI. How do we get ROI? It is our profit all over our written down value, because it's written down values times 100. And remember, in most cases, you prefer operating profit. Operating profit. And our operating profit, my students, all over capital employed here, our operating profit has been given. Yeah, we know it. I rubbed mine. Unfortunately, I rubbed mine. So the operating profit that I have here, the operating profit, it is 410. Yeah. We have here 275. Yeah. Then we have 140. Then we have 5. Then we have negative 130. These are the operating profits. So you divide this by the beginning written down values in thousands. So divide by 1,000, divided by 800, divided by 600, divided by 400, divided by 200, times. Yeah, written down value is the same as what your capital employed. Yeah, times 100. I'm introducing this one because at times the examiner keeps on using them interchangeably. Yeah, interchangeably. So do you have these figures, my good students? Do you have the first figure? I'm being told is 41%. The first one is 41%. Thank you so much. The second one is 34.38%. Two decimal places, 34.38%. And then we have the third one, 34.38. Yeah, thank you so much. Then we have the third one. So the third one, what do we have there? The third one, 23.33%. 23.33%. From there, we have the fourth one. So the fourth one, what do we have there for the fourth one? Fourth one, I'm being told it is 1.25, quite small, 1.25, sorry. Yeah, and then we have a negative something, a negative return. The 𝐂𝐶𝐮 man, a negative return, which is negative what here? Negative 5%. So should they want average, then will give us total ROI. So are you able to give us this total ROI? Please add up everything. 41 plus 34.38 plus 23.33 plus 1.25 minus 65. What are we able to get? I just want the total. Yes, in the case they never ask us here, but in most cases they do ask. In most cases, they really ask. So I'm being given 34.96. 34.96, yeah. And then, ladies and gentlemen, we have here average. It will be this 34.96% divided by 5. So this ROI and residual income, they suffer from some disadvantages. The first disadvantage is that they encourage what we call short-termism. They encourage what we call myopia in management, myopia. So under myopia, basically managers will be thinking of short-term profits, short-term objectives. So they want to grow only this year's profit. So for them to grow this year's profit, what they shall do, they shall cut down on trainings. They will not even advertise because they know every expenditure matters. If you incur an expenditure, then at the end of the day, your profits will be going down. So if they continue like that, then in the long term, in the very long term, there will be an issue with this organization. It will not be a going concern in the long term. Because for you to be a going concern in the long term, you must invest. You must invest heavily. Today. Yeah, they encourage short-termism because they are profit-based. They are performance measures which are based on profits. They're based on profits. And then, ladies and gentlemen, now both of them, again, if you're asked about their disadvantages, always ensure to say that, they are quantitative models. They don't take into consideration of qualitative factors. They are quantitative model. They think that money is everything in life. It has never been everything. No. Money is just but a means to Some good life, I agree, but you can't tell me that money is everything. They are qualitative factors, all right? And I'm being given there, in this case here, the average, which is 6.9 something percent. Yeah, so then let's look at another past paper question. Yeah, today we are going to do 3 of them, and then we will be able to take a break. So I'm looking at, yeah, easy questions really. Like what came in December 2022? December 2022, question number 2. Let's go to December 2022, question number 2. December 2022, question number 2. December 2022, question number 2. And please mark the questions from your past papers that I do. A good teacher should do a minimum of 60% of the past paper questions by the end of the semester. By the end of the semester, we should do about 60% in class. And then now if you put yourself some effort and do the, say even 20%, then you will be way up there. So December 2022. Question number 3. Question number 3A. December 2022, question number 3A. Have you guys gotten that question really? Have you guys gotten that question? December 2022, question number 3A. They asked us to use life cycle costing. Yeah. And then number 2, use accounting rate of return. Thank you so much. Thank you so much. And of course, as usual, you can take a screenshot so that you send that screenshot to the group. Great. So then what are we told, ladies and gentlemen, here? 𝐂𝐸 Limited is organized into divisions. Divisional managers are rewarded through a remuneration package, which is linked to accounting rate of return performance measures. Venus division of 𝐂𝐸 Limited is currently investigating 2 mutually exclusive investment proposals, namely MX, JX. If the proposals are viable, Venus division wishes to assign priority in the event that funds may not be available to cover both proposals. Details of the 2 mutually exclusive proposals are initial cash outlay or non-current assets. You can see we need to put in for X 192,000, for JX as well 192,000. From there we start getting benefits. We can see years 1 to years 4, I will be getting 7,200. Note number 1. The management assesses the cost of capital at 16%. So cost of capital is 16%. Note 2, the accounting rate of return calculation is based on the accounting profit, which is computed by adding back depreciation to net cash inflows of each year. Note 6, depreciation is on straight line basis over the asset's useful life. Note 7, net present value method is used to estimate the most viable project when using project life cycle costing. Ignore tax on residual values. The present value factors are given there. So advise the management of 𝐂𝐸 Limited on the most viable investment proposal using the following performance appraisal measures. I've already talked to you about product life cycle costing. And a product life cycle costing, you track, if it's these cash flows, you track all cash flows over the entire useful life. If the examiner wants you to discount, then you discount. You simply give us net present value, which will be able to accommodate all the cash flows for the entire useful life. So then there is no problem. We start with the project MX. This examiner loves you people because you can see project MX. He has given us already, we have time. Yeah, 0, 1, 2, 3, 4. And then he has given us, in this case here, cash flows. He has given us cash flows. So cash flow at time 0, 192,000. This is an outflow. Time 0 is now 192,000. Oh, Is it? I'm being told by Chep Coril that's supposed to be question 2B. I don't know. Is that the case? Is it supposed to be question number 2B? So I don't mislead other students later will be watching these videos. Yeah, thank you so much. Then we go to year number 1, we get 67,200. Year number 2, I'm getting 67,200. Year number 3, I'm getting 67,200. Year number 4, I'm getting 67,200. Basically annuities. Annuities. But even if they are annuities, I can still treat them as independent cash flows. Independent cash flows, and I use PVF instead of PVFA. So who knows the PVF at time 0? At time 0, the shilling is a shilling. It's 100%. Yeah, no depreciation of the currency. So at time 0, we always stand at 1. And then now you can see they have given me the other years PVFs. The other years PVFs have been given to us. So the first one is 0.8621. 8621. Then we have 7432. 7432. Then we have 6407. 6407. Then, ladies and gentlemen, we have 5523. 5523, like that. So then can you be kind enough by giving me the PV, which are the discounted cash flows? So then this times this gives me minus 192,000. Then we have this times this. Please give me a number to write there. Yeah, you have to give me many decimal places for accuracy because there is something I would want us to try. And I'm happy because now we are at least 77 is a good number. 77 is a good number. So from Shayla, 57,933.12. Then we have this 67,200 times this. Remember, it's the entire life cycle. 67,200 times 0.7432. 49,934. 49,934.49. 934.943 actually. 943 actually. 0.04. Thank you so much. 0.04. And then we have 67,200 times the next one. 43,055. 43,055.04. Thank you so much. And then now we have the last one, which will be this times that. 37,114. 37,114. 37,114.56. 0.56. So come and give us the total, the net present value. Give us the net present value. Net present value. Now you can add all the discounted cash flows. Remember, these are discounted cash flows. Discounted cash flows. So according to Chep Coril, she's getting 37,114. No. That's for year number 4. So according to Chep Coril again, 168, 836. 836. 0.76. So even if we'll be doing comparisons later, so long as you get a positive NPV, simply be putting in brackets viable. That can give you a mark, which can make you see places that you've never seen before. So this is viable. Viable. So up to here, ladies and gentlemen, are we together? Are we together up to here? Today they are not really talking so much. I don't know why. Perhaps they are hungry. All right. So we have here. They're saying no. They're saying it's supposed to be minus 39.54. Please confirm whether this answer is correct. Confirm whether this answer is correct, because I'm being given a different figure, minus 39.54. Sorry for that. Sorry for that. Chip Koril, you can just check where you went wrong. That's live. So minus 39.54. Minus 39.54.24, like that. Another bright student would have thought of doing this question this way. This was another student would have thought to do in this kind of a question. Yeah, somebody would have come here and said, I mean, this MX is an annuity. So they would have taken this 67,200 PV-FA. Have they given us the cost of capital? 16%. 16%. How many years are we getting this 67,200? 4 years. 4 years. Minus the initial outlay, which is 192,000. Minus 192,000, like that. Then come here and compute PV-FA. So PV-FA will be 1 minus this marked up from 100%. So it will be 116%. So 1 minus 116%, so 1.16. Raised to the negative of the year, -4, all over this percentage the way it is. That's how we get PV-FA. Present value, interest factor of an annuity, which in this case here, Maggie is able to give me as 27,982. 27,982. 27,982, like that. So then, ladies and gentlemen, the net present value will be 67,200 times 2.7982 minus 192,000. I'm doing this because I want to prove to you that we are going to get the same answer at the end of the day, so that I will not leave you behind. I mean, imagining how comes that guy never used PV-FA. We'll end up getting the same answer. We'll end up getting the same answer. Negative 39, 60, negative 39, 60, negative 39, 60, point what here? 0.96. So the other answer that we got using the other method, is it pretty close to this answer? Is it pretty close to this answer, or are they worlds apart? It's pretty close, yeah. It's only rounding off errors. Only rounding off errors. And if I were you, I would stick with the first method. I would stick with the first method. So then are you able to go ahead and now give me the net present value for the other project? Net present value for the other project. You see, we're following the same procedure. Let's follow the same procedure. Net present value for the other project. With your permission, I'll be able to rub this. So now here we have project JX. Project JX. So project JX, we have the time, which is 0, 1, 2, 3, 4. Then give us the cash flows. $192,000. We have 32,000, 64,000, 96,000, 128,000. Fortunately, we have the present value interest factors, the discounting factors. We copy them the way they are, not forgetting that the PV for time 0 is always 1. Yeah, so please do the multiplications. Do the multiplications, and me, I will be interested in the net present value here. I will be interested in the net present value. Add everything. So remember, if that NPV, the first one, was negative, I hope you say that the project is not viable. If it's negative, we shall say that the project is not viable. The project is not viable. The project is not viable. So Maggie, is this the summation of everything? I simply want you to give me the summation of everything. I want you to give me the summation of everything. I want you to give me the summation of everything. So according to Shayla, this is supposed to be 15.353. 353. Yeah, so this is viable and of course bigger than for project X. So using life cycle costing method, we recommend job X. We recommend JX. The project is viable, and because it has a bigger NPV than the other one, so therefore we are recommending project JX. 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 So up to there, ladies and gentlemen, are we together? Are we together up to there? Boy, they're not talking to me now. Yeah. So then they want us to go ahead and compute the accounting rate of return for each of those two projects. Accounting rate of return for each of those two projects. So accounting rate of return for each of those two projects. So tell us there that accounting rate of return is based on operating profit. It's based on operating profit. It's based on operating profit, which is computed by adding back depreciation, computed by adding back depreciation to net cash inflows. To net cash inflows. To net cash inflows. So you're saying that ARR is based on operating profit, which is computed by adding back depreciation to our cash flows. Yeah, like that. So remember, ladies and gentlemen, we normally start with a profit before depreciation and tax. Yeah, we less depreciation. Yeah, then we are able to get profit before tax. Yeah, then we less tax. If you remember this approach, we get PAT. Yeah, and then we add back depreciation. Yeah, to be able to get cash flow. Yeah, great. To be able to get cash flow like that. So in short, we are saying, ladies and gentlemen, PAT plus depreciation will be equal to who we are? Will be equal to cash flow. Will be equal to cash flow. Mm-hmm. Mm-hmm. So ARR is based on operating profit, which is computed by adding back depreciation to what year? To our cash flow. We shall take a break, ladies and gentlemen, 5 minutes, not 5, but 10 minutes break. When we come back, that is where we shall be able to pick from. So exactly 10 minutes, and ensure that you take a cup of a glass of water. A glass of water. Great. Can we continue? Thank you so much. And I would want us to start by making a change. I realized I've confused here. You see, from this equation, yeah, once you get PAT, you always add back depreciation to get cash flow. And you're saying that this PAT, the profit after tax, plus in this case here, the depreciation is how we are able to get our cash flow. So then if you would want to get, in this case here, profits generally, then what are you supposed to do? What are you supposed to do? What are you supposed to do? So accounting rate of return is based on operating profit, which is computed by adding back depreciation to cash flow. That is not correct. Because when you are given cash flow here, it automatically means that for them to have gotten this cash flow, what do they do? They took profits and added back depreciation. So therefore, to get this profit generally, from even this one here, you should take cash flow, and then you less what here, somebody? You less depreciation. So please change this slightly, that ARR is based on operating profit, which is computed by deducting, sorry for that, by deducting, yeah, depreciation from cash flow. Because you see, ladies and gentlemen, when you are getting, in this case here, cash flow, what does it mean? You've been able to take your revenues, you've been able to deduct your cash flow expenses. But you see, profits should also be able to incorporate what here, non-cash flow expenses. So to be able to get profit, then we have to deduct this depreciation and any other non-cash expense. So anytime you remember this, you can easily pick it from here. That to get profit, you are taking cash flow, you deduct what here? You deduct our depreciation. You deduct depreciation. So then what you're going to do for this project MX, so for project MX, we have our cash flow. So project MX, we have our cash flow. Yeah. So our cash flow is here. We are given 67,200. That's 1, 2, 3, 4, 5. So we have here 67,200, 67,200, 67,200. We don't have here 5 actually. So come here and less our depreciation. Are you able to see depreciation, my good students, somewhere there? Are you able to see depreciation? We must compute it. We must compute this depreciation. So this depreciation, to get it is really, really easy. To get depreciation, we are taking the initial cost, we subtract the scrap value, divided by number of years, which are 4. So are you able to see the initial cost in this question? Initial cost of this project. Somebody talk to me. Initial cost of this project. Initial cost of the project. It is 192,000. It is 192,000. 192,000. Do we have any scrap value? Have they provided a scrap value? No. No scrap value. No scrap value, 0. So divided by 4. So then at the end of the day, we shall end up getting what figure? At the end of the day, we shall end up getting what figure? 48K, isn't it? So we have here 48,000. Yeah, 48,000. Then we have 48,000. Then we have 48,000, like that. So then you come here and deduct this pretty fast for you now to be able to give us our profit. So deduct this pretty fast for you to come and give us the profit here. The profit. So this profit, how much do we have here? So the first one, I'm being given a figure of what here, somebody? No. 19,200, 19,200, yes. So I have here 19,200, 19,200, 19,200, 19,200, giving us what total? giving us what total? So remember, this is the rate of return, eh? Yeah, the accounting rate of return, but for 4 years. For 4 years. For 4 years. So you take this figure, yeah, plus this, or this times 4. How much are we getting? We are getting 76,000. 76,000. Yeah, this straight line, no problem. Therefore, the accounting average rate of return, yeah, the accounting rate of return, the accounting rate of return, or average accounting, or ARR, yeah, accounting rate of return. So I will take this 76,000, you divide by 4, which gives me 19 what here? 19,200 like that. 19,200 like that. This is for project X. Can you kindly do for the next project here, which is project what here, which is project Y? TX, I mean. Now this one is yours. This one is yours. Can you take this as an assignment? You do it later. It's very easy. You simply take the cash flows given, you chop the depreciation. You are left with profits. Add them, divided by 4. Add them, divided by 4. I believe this is something you can do later on to just give us a time to tackle 2 more questions. We tackle 2 more questions. So this question that I would want us to tackle now is quite a bad question that students were not able to get very well. So I'd want us to do August 2024, question number 5A. August 2024. August 2024. August 2024. August 2024. Yeah. Question number 5A. Once you get it, could you kindly say hi? ARR, I'm lost. So remember ARR, the accounting rate of return, what do? You get profits and then you average them. So like the cash flows are given. So to get profits, how do you get profits? You take the cash flows, you deduct depreciation given. Yeah, and then you'll be able to get profit for each of those years you add there. You divide by 4. Yeah, you divide by 4. Maybe you watch the video and then if you have a problem, we can always repeat the question. This is a question of Greenlight Limited. August 2024, question number 5A. Is there somebody who has been able to get that question? August 2024, question number 5A. Anybody who has been able to get it? Yes. So you're told here Greenlight Limited is a government agency generating company. The company is segmented in subunits. The following is the selected divisional annual information for its 2 targets, subunits. So you have the division X and division Y. So I can see sales turnover. I can see operating income. That is very, very important. I can see average total assets. I can see current liabilities, etc. So then what are they telling me there? Calculate and comment on each of the following financial performance measures for each subunit. So we start with ROI. So ROI, for us to get ROI, ladies and gentlemen, what do? We normally take, in this case here, preferably operating profit. Whenever you have many profits, always work with operating profit. So operating profit over capital employed. Over capital employed times 100. So remember, we have got 2 types of ROIs. Yeah, we have in this case here 2 types of return on investment. We have what we call the operating ROI, where you use operating profit there, and we have what we call the net ROI. Not net ROI, you use PAT, profit after tax. So we have 2 divisions here. We have X vis-a-vis Y. So are you able to see the operating profit, ladies and gentlemen, here for X, where operating income, operating profit? Are you able to see 82,500? I'm alone. Is there somebody who is able to see 82,500? Yes. How about the capital employed? How about the capital employed for X? You simply walk along the column of X. The capital employed, I can see it is there 188, isn't it? 188,000. So then can you kindly give me this percentage? Kindly give me this percentage. Yeah, so I'm being given 43.88 for X. So this is 43.88% for X. And then for Y, what do we have there for Y? So for Y, ladies and gentlemen, we have our operating income of 114,000. And I can see the capital employed as well in Y happens to be what they are? 188,000. Sorry. Yeah, it's 188,000 capital employed for Y as well, times 100. So are you able to give me this? 60.64. They wanted us to comment, ladies and gentlemen. When they want us to comment, you have to be very careful. Of course, you can see that Y is posting a better performance than X. But again, if you look carefully, they have given us some targets down there. There are targets given down there. Are you able to see the targets? 4 measures are used to evaluate the performance of the subunits based on the data above. The budgeted performance measures for the subunits. They are budgeted for this in advance. So you can see ROI for X targeted ROI or budgeted ROI. They were budgeting to get 25%. To get 25%. And then this one here for Y, they were targeting to get what here? 20%. So in terms of comment, we are able to see, ladies and gentlemen, number one, that Y posted a better performance. Posted a better performance compared to X. Compared to X. And we are able to see, number two, that in this case here, both departments exceeded targeted ROIs, targeted return on investments. Yeah, this is good. Good for the business. Good for the business. This is good for the business. So whenever you're given those budgeted metrics down there, always remember to make a comment. You can see both of them. Like this was more than this. This was more than this. So that's really, really good. So can we go to the next performance measure? What they are calling residual income. Can we go to residual income? Residual income. They are silent. We shall overcome. We shall overcome. Very good. Now for residual income, I want to give you 1 minute to see whether you'll be able to get this residual income. Let me give you 1 minute to see whether you ninjas will be able to get this residual income. I'm giving you 1 minute. And then we get to see whether these ninjas are able to give me residual income. So long as you remember the formula, then that will be it. So long as you remember the formula, that will be it. So do you have other classes after this? Thank you so much. Oh, you are not free. FR, okay. I thought you were free. I thought I was actually envying you because for me, I have Saturday, I have classes back to back. Sunday, the same back to back. Yeah. Somebody was enjoying me the other day that Mwalimu, you tend to be more of a student than those students you are teaching. Yeah, but the good thing is that I'm enjoying my work. I'm enjoying my work. I love what I do. I love what I do. I love what I do. And since I took this teaching now full time, yeah, actually it has even become better. I don't think there is any other work. Even when you guys will become presidents, ministers, don't give me any work. Yeah, don't give me any other job. Let me just teach and audit. But you're going to give me audit jobs, taxation jobs, those ones, yes. But like you're appointing me to become minister, no, I don't want. I don't want. Let me just teach. All right. So then we have here our residual income, yeah, is a profit minus cost of capital employed. So for X, remember, in most cases, these performance appraisal models, we prefer operating profit. So the operating profit for X is 82,500 minus cost of capital. Are you able to see the cost of capital down there? They give us cost of capital of 12%. So 12% of the capital employed, not of the total assets, but of the capital employed. So X, I'm being told by Shayla, it is 59,940. 59,940. 59,940. And then Y, I can see the operating profit for Y. Operating profit for Y, which is the same as operating income, is 114,000 minus 12% of 188,000. Are you able to give me the one of Y? 91,440. So the first comment in terms of performance appraisal is again to recognize the fact that Y is posting here, posted better performance compared to X, Why? Because generally, the higher the residual income, just as it is with ROI, the higher the residual income, the higher the ROI, the better the performance. Better performance. Do we have any targeted residual income? Yeah, you can see residual income targeted in terms of thousands, because these figures are thousands. You can see the targeted. You can see the targeted, yeah. You can just be very creative, just become creative. So we have here target. So we can see again target, X the target, residual income is 30,000, because I have to put this in thousands. Yeah, and for Y, the target is as well 30,000. Yeah, target is 30,000. So both divisions exceeded their targets. Both divisions exceeded their targeted residual income. Their targeted residual income. And then you say dash there, very good. Very good performance. Very good performance. Very good performance. Now, ladies and gentlemen, from there, we shall be able to straight away take on the next one. Are they ready for the next question? Are they ready for the next question? 91,440. Yes. The next question is about EVA. EVA is very, very similar to residual income. EVA is very, very similar to residual income. EVA, economic value added. Economic value added. So this EVA is very, very similar to, yeah, you see residual income, we talk of what here? COCA, or rather profit minus COCA. Profit minus COCA. Yeah, forever, we shall talk of NOPAT minus WACC times, in this case here, capital employed. NOPAT minus WACC times capital employed. Yeah. So NOPAT is net operating profit after tax. NOPAT is net operating profit after tax. Net operating profit after tax is net operating profit after tax. Net operating profit after tax. And how do we get this NOPAT? So to get NOPAT, normally, because it's operating profit, you take this operating profit, PBIT. You take the operating profit times 1 minus tax. 1 minus tax, that is NOPAT. Anytime they want us to get NOPAT, you take the operating profit, i.e. operating profit into 1 minus tax, like that. And now you can go ahead and they give us no part for X. Give us no part for X. Fortunately, they have given us the operating income for X, which is 82,500. 82,500 times 0.7. I'm so sure you haven't yet seen where I got 0.7 from. I'm 100% sure you haven't seen where I have gotten 0.7 from. I'm 100% sure. So this 0.7, I said 1 minus 0.3 because tax has been given as 30%. So I said 1 minus 0.3. Yeah, which then in this case, it will give me 57,750. 57,750. 57,750. Yeah, and then no part for Y. I can see the operating profit for Y. Operating profit for Y, I can see it is 114,000. 114,000 times 0.7, which will end up giving us a what figure? 79,800. Thank you so much. 79,800. Then now you can go back and apply the formula. Apply the ever formula. So the ever formula, of course, we know it is no part minus WACC, if it is there, times capital employed. If it is there. So in this case here, then for X, no part is 57,750. We don't have WACC here, but I wish they were to give us cost of equity, cost of debt, and then they wait, and then they tell us to compute WACC very well. So in this case here, we simply use cost of capital given. 12% multiplied by, yeah, the capital employed of 188,000. Of 188,000. So then are you able to give us an answer for X, ever for X, 79,800? Right? It can't be that big. It has to be smaller than 50. $35,190. So I'm being given a figure of $35,190. And then you go to Y. So Y, ladies and gentlemen, I can see no part. No part for Y is 79,800 minus 12%. 12% of the capital employed, which was 188,000. So is there somebody who could be having this and then we make a comment? I'm being given a figure of 57,240. 57,240. So again, in terms of value addition, in terms of ever, yeah, again, we are seeing that Y is really doing very, very well. It's really doing very, very well. Very, very well. And I can see both divisions have been able to meet the targeted EVAs. I can see both divisions, they have been able to meet their targeted EVA. Because you can see X, the targeted EVA there is 33,000,000. Yeah, so we posted better performance than that. And then you can see the other one, 5 million. We posted though close, but we are ahead. We have exceeded expectations. We have exceeded expectations. We have exceeded expectations. So will you be able to allow Mwalimu to take on the next question, the last question for us? The last question. Yeah. So the last question, they want us, ladies and gentlemen, there to give them assets turnover ratio. Here you have to be very, very careful. You must be very, very careful. Otherwise, you will end up messing. So we have here assets turnover ratio. I remember what my teacher told me. It's like here there is an over. So basically, this is supposed to be assets over turnover, but he told me something that I always remember up to date. You see, they want you to turn over this formula. So they want you to reciprocate. So don't write this. So basically, whenever you hear of asset turnover ratio, this one will be the turnover on top, all over the assets. And remember that turnover is the same as what here? Sales. Turnover is the same as sales. So in most cases, the examiner will tell you which assets turnover ratio they want you to compute. If they tell me that they want me to give them total assets, turnover ratio, then I will take sales over total assets. Yeah, I will take sales over total assets, if it is total asset turnover ratio. And I will go ahead to compute the total asset turnover ratio for each one of them, for X and for Y. So in this case, are you able to see the sales figure? Are you able to see the sales figure for X? Sales figure for X, it's up there. It is 875,000. We divide this by the total assets of X, because I'm getting total assets. So I can see average total assets, 250,000. So remember, this comes as a number of times. Don't multiply with 100. It comes as number of times. So then X at the end of the day will be able to give me abracadabra. X at the end of the day will be able to give me abracadabra of 5.5. The higher the turnover ratio, the better the investment. For Y, am I able to see the sales turnover for Y? Yes, it is 1368,000. All over the total assets, I can see the average assets were 456,000, which will end up giving me what figure? 3.5, isn't it? So this, I'm told, will give us 3.5 like that. So at least for once, we have seen a situation where X is posting a better performance. 3.5, okay, for X, okay. I was really here complimenting now X. So 3.5 versus what here? So 3.5. And then Y is supposed to be 3. Y is supposed to be 3. Great. So still, we are in agreement here that at least for once, we are able to see that X has posted a better performance in comparison to Y. Because remember again, the higher the assets ratio, the better. The higher the assets ratio, the better the project is. How about the targets? Have they met the targets? Yeah, I can see the asset turnover ratio. X has been able to exceed its target. X has exceeded its target because the target was 2.36. X got 3.5. So it's able to fly over the hurdle rate. But when you look at Y has not even met its target. Y, 3 is less than, which in this case here, 4.12. So this is really, really bad that now we are not even able to meet our targets. So then we should be able to summon the manager of Y and talk to them. We talk to them. Because that's a bad variation. Depending on what you are targeting versus what we have gotten, these are bad variation. This is bad performance. Y has not met its targeted assets turnover. All right, my good students. After that, you can see, you have two types of asset turnover ratios. I have to show you the other one. Yeah. At times in this case here, you will get the examiner talking about net assets turnover ratio. Actually, what I normally tell my students, if the examiner is silent like this examiner, always calculate both of them. So when they talk of net assets, then I will take sales over net assets. Sales over net assets. So sales for X is 875,000 divided by, is there somebody who is able to see the net assets over X? Anybody who is able to see the net assets of X? Remember, I told you something. The net assets is the same as what? Net assets is the same as what? Net assets is the same as what here? Capital employed. Thank you so much, Bahati. Same as capital employed. I simply wanted to show you how to do this using just one example, and that will be it. Yeah, that will be it. How many times? Of course, they will not be the same because here we are covering net assets. The other one we were covering total assets. Just in case the examiner speaks to each one of them, it will be easy for you to relate, and you don't start crying outside here like you're coming from an exam room, having been hit by a bomb, like that. So, gentlemen, because we have classes back to back, I would want to excuse myself. I believe you have done justice to this lesson. Actually, if students were good at watching videos, all of you in the class, 400 plus, then automatically I would have told everybody to watch this video. So now tomorrow I can start on my second last topic, which is inventory. But of course, you guys being students, a student is a student. You can't preach that gospel to them. They'll keep on crying forever. So I'll be able to continue with this slightly then tomorrow. And then I want to finish my syllabus very early so that every class now becomes a special revision. We would want to have an easy life in our exam time. Otherwise, ciao, bye. Yeah, all right, bye. Great, thank you so much. Be blessed big time.